Yeah.
Okay, so thanks for that very generous introduction, Roddy. Now I'm going to fly through a bunch of slides in the next 25 minutes, leaving a few minutes at the end for any questions. This is going to be a worldview, as Roddy suggested, by a journalist focused on finance, journalist focused on the sector. Now, when I was due to give this talk a couple of weeks ago, I thought this was going to be a good news slide because I thought we'd seen the back of food price inflation. However, with the budget and the tax increases that came through that's going to be passed on. So we'll see a slight bump in food price inflation. We can also have, potentially see some real volatility on food prices if the farmers follow through on their threats. So yeah, so in the space of 2 weeks, this has gone from good news to potentially bad news. Energy prices. This is an indication of just the sort of volatility we have been through. This is a plot of the rate of change rather than the price of electricity. This is a plot of the price of gas, and you can clearly see the run up there. And we're now back to where things were. So unlike food, which has not really come back down, at least energy prices have come back down. There is some hope, perhaps, that energy prices might drop. I think that's going to be a forlorn hope. Well, it's certainly cheaper, as this data indicates, to generate electricity via renewables. The reality, there's two big challenges with renewables. One is connecting them up to the grid, and by definition, an offshore wind farm is not that near a population centre, and there's going to be lots of pylons snaking across the country to connect that offshore wind farm as a result. And the second thing, which I think is the biggest thing, is storage, energy storage. And we have no affordable solution to that. And the wind doesn't always blow, the sun doesn't always shine. So renewables are a big challenge if we are going to switch off our gas-fired power stations, as this government is threatening to do by 2030. So maybe the 22 billion they're putting into carbon capture will help alleviate that, and we keep a few of the gas-fired power stations open. But I think we have severe challenges with energy. The only ray of light I can give you is that we already have industrial electricity costs which are just about the highest in Europe, and European electricity costs are so high relative to both the US and China, that's actually causing, in many people's views, deindustrialization. The one thing to watch for is if they do ask you to switch off your gas boilers, it costs 3 to 4 times more to heat a building with electricity than it does with gas. So that's potentially very nasty, stinging the tail if they do go for the gas boilers. If you think things are nasty with energy, look away now, because I think the labour cost piece is pretty terrifying, both in the short and the long term. This is a very busy slide. The thing to note, I think, is at the tail end there, where you're seeing wages in real terms increase, and I think that's going to be a trend we're going to see going forward. This is an interesting slide in terms of the volatility we've had in labour prices due to the COVID lockdowns and the sharp recovery. The lime green thing is construction. The maroon coloured line, that's includes hotels and restaurants, but also includes wholesaling and food retailing, which were less volatile. If we strip that out and just have hotels and restaurants, it could easily be as volatile as construction was. Right, so this was the big one in the budget. That employer national insurance contributions increase, very painful, as I'm sure you're all aware. It's not just the headline rate going up from 13.8% to 15%, but real pain in our sector as a result of the decrease in thresholds. These have dropped from 9,100 down to £5,000. And this particularly hits lower paid workers. So if you have an employee on £20,000, the increase in national insurance you're going to have to pay as an employer is 50%, 50%, a huge jump. If you look at, say, the median wage, which is just over £36,000, in the UK, the increase of NICs in that is 25%. Still a big jump, but obviously, half of what on the lower paid employee. And I think this is really going to impact our sector. In addition to that, of course, we saw the increase in national living wage, and this is a huge impact. Just to give you some idea of the scale of this, analysts at Morgan Stanley looked at what's happening at Wetherspoon, the pub chain, and they reckon the combination of national living wage and the employer NICs increases is going to add about 2.5% to Wetherspoon's cost base. Wetherspoon is a relatively low margin business, so Morgan Stanley reckon about a third of their profit before tax is going to be wiped out. And you can see the impact of this in terms of Wetherspoon's share price over the last week or so since the budget, which has been sharply down. And I think that reflects just the challenges hospitality businesses have as a result of this budget, these budget measures. I'm afraid, to add further to your gloom, the Employment Rights Bill, which is due to hit the statute books at some point in 2026. Now, this is going to add a huge amount of costs in terms of your regulatory costs, administrative costs, possibly worse than those employer NICs increases. You're aware, I'm sure, about the end to 0 hours contracts, but there's a lot of extra things in here in terms of parental leave, paternity leave, maternity leave, effective from day one. There's things which I think are going to specifically impact hospitality employees. There's a clause in here which talks about how employers are going to have an obligation to prevent harassment of employees by third parties. So if a customer shouts at one of your members of staff, you're going to have some exposure there. The exact nature of this is still to be determined as it winds its way through Parliament, but it's going to be pretty impactful, I suspect, and given the Labour Party's majority, I think it's going to be pretty much as it's written in the bill. So that's a lot of short-term pain in terms of labour costs, regulatory and tax. I'm afraid we've got long-term pain as well because we have a shrinking labour pool. So we're not having enough babies. The age cohorts are getting ever smaller as they come into the workforce. And this is going to be compounded by restrictions on immigration. So if we have a right of centre government coming in, which might alleviate your tax burden and your regulatory burden, it's probably going to make things worse from an immigration perspective by tightening that particular screw. So I think what you win on the left wing roundabout, you'll lose on the right wing slide. I don't think there's any solution here in terms of labour costs, and it's the biggest challenge I think the industry faces in the next few years. Better news in terms of interest rates. We have got the end of the zero interest rate policy period, thank goodness. I think it's a real problem in terms of it. We just had stagnation economically, so it's good to see the back of it. Obviously, there's pain in terms of interest rates, which in my view are just been normalizing, but we are about to enter a period of rate cutting. And in one of my go-to forecasters, Capital Economics, thinks it's going to be 3% by the end of next year. And they said after the budget that they're sticking with that forecast. The Office for Budget Responsibility, the fiscal watchdog, is not so optimistic. They've got a much gentler curve in terms of the rate cutting. The budget, they think, added about 25 basis points to where interest rates are going to finish because of higher inflation and higher government borrowing. But still, we do have at least decent cuts on the way. Also, I think there's relatively good news in terms of commission rates for distribution. This is due to the pressure on the duopoly of Booking and Expedia coming under threat from new entrants. I would particularly point to Trip.com, which is in at number 7 there on that list. Trip.com is a giant Chinese OTA They are based in Singapore. They're making a big push into Europe, and this is putting pressure on commission rates. Similarly, Airbnb, we've had a hate relationship with them, but they're looking to add boutique hotels and independent hotels to their platform. They're struggling to add their traditional base of private rentals, and they're looking for other supply. Airbnb is a relatively low cost and effective platform. Looking further ahead in terms of distribution, we're going to have massive disruption thanks to generative AI. Nobody is clear yet exactly what it's going to look like. This is Expedia's AI assistant. But I think the big winners here are going to be the likes of ChatGPT, Anthropic, Google's variant Gemini. I mean, these are effective already. I'm going to Stockholm in a couple of weeks. I, out of interest, asked ChatGPT to book my hotel and my flight, and it came up with a pretty good selection, actually. And that's going to tighten. The challenge for the OTAs, Booking and Expedia in particular, is where do they spend their billions of dollars in advertising when it comes to sort of a chat GTP interface? It's hard to see how they're going to maintain their presence in the market. Okay, so moving on to demand outlook. So we're back to where we were pre-pandemic lockdowns. That rate increase that STR has there is a nominal rate increase. So in real terms, we're pretty level. The outlook is pretty good. Most people are expecting profits to be higher this year than last year. I think if you had this survey, and this is a global survey, not just UK, Hotstats conducts, I think if you asked for 2025 outlook, given what I've just said about the budget, it's going to be entirely flipped. Most people are going to be expecting profits to be a lot tighter in 25. We have done really well in terms of the recovery, in attracting tourists to the UK. Partly this is a function of the Chinese lockdown lasting for longer. So places like Thailand, which pre-lockdowns was in fourth place in the rankings, it's dropped right out of the top 10. It'll come back as the Chinese get back on planes. Look at the spending; it's sort of back to where it was, probably a little bit more recovery to come in that spending still. But overall, we have great tailwinds as a sector. There's lots of data points out there. I think this is quite interesting. Over the next decade, we're going to see a third increase, or rather the overall airline fleets globally are going to increase by a third. That's a CAGR of almost 3%. That's a fantastic outlook, I think, as an industry. And you can't have any discussion on what's happening with consumers without talking about the shift in spending towards experiences. This includes services, which is not just experience spending, but the point it's making is, consumers are switching away from goods, as can clearly be seen. Supply, this is my only slide on supply. It's from Whitbread's end of year results earlier this year. 3 points to make on supply. The first is the decline in the volume of supply, the room numbers we have. The second point is how it's coming back very slowly, and that's a function of development finance, which is pretty tight, as is normally the case during a downturn, and it's the slowest to come back. And the third point I would make is what's going to happen to family-owned businesses in our sector. We are seeing, as usual, the farmers get all the publicity, but family-owned businesses in our sector are really going to come under pressure as a result of those changes to inheritance tax laws. And I think that's only going to accelerate the decline in the independent sector. Now moving on to the investment market, Expo Real is the biggest real estate investment show in Europe. 40,000 people turn up each year at the beginning of October in Munich. Last year when I went, it was a very depressed affair. I felt like I needed to give out Prozac on the doors. This year, much more, well, I wouldn't say optimism, but people felt they knew where they were this year. There's a sense of that we have hit bottom in terms of prices. in terms of the price corrections that were going on. So last year I wrote a story. I talked about how hotels were the least ugly of the in the ugly baby contest. This year I'm able to talk about hotels winning the Bonnie Bairns contest. Hotels up on the podium with data centers and life sciences. Still problems in the three big commercial real estate sectors of office, retail, and warehouses, industrial. Office hit by the work from home phenomenon, retail ongoing problems with e-commerce, and there's a big price correction with warehouses. Fundamentally, warehouses are very solid, but there was such yield compression during that zero interest rate period, down to sort of 2% and sometimes below, that as interest rates rose and they had to push yields further out, massive price corrections have resulted, which has disrupted the market a bit. So very good atmosphere and appetite relatively for hotels. Okay, so just to conclude, just to go back on that labour cost piece of a typical hotel, it's something like 40% of the cost base is labour. How you deal with that, how you're able to keep delivering meaningful experiences to your guests while coping with those sharply increasing labour costs is going to determine the winners and losers of the future. The demand supply outlook is looking very good, actually. So supply very constrained and demand ongoing strength, and that transaction market is coming back. It is coming back slowly. The bid-ask spread is closing. If you look at those interest rate cuts, going from a 5% base rate to a 3% base rate is a 40% drop. That's a big shift in terms of debt costs. That's really improving the mood of buyers. Of course, what buyers actually borrow at is determined by the lenders, and the lending margin is going down as traditional banks return to the market. So there's a very good atmosphere there amongst the buyers, which is helping to close that gap. Don't get too carried away, though. We see some headlines sort of hotel or transaction volumes double. Well, if you double very little, you still get little. And I think it's going to take a number of years before we get back to previous peaks. I couldn't resist just leaving you with this slide on the budget. We are seeing in Britain a huge change to how we run our economy. The size and presence of the government in our economy is going beyond all-time records. I mean, to be fair, it was already heading that way under the Conservative administration, and now it's shooting way beyond it under this new government. I will simply say that I'm not sure we've had a proper political discussion about this massive shift in how we're running our country. And with that, thank you. You can listen to us on podcast for free, Hotel Analyst, and that's the Hyde event Roddy talked about, where we're putting people like technologists, designers, operations people alongside investors just to try and get a bit more of an interesting conversation in that. You can get half-price tickets if you're a hotel owner, and similarly, there's the Operational Real Estate Festival in June. With that, thank you very much.
Andrew, thank you very much indeed for something of a whirlwind tour, but certainly packed with nuggets there. If anybody has any questions, please just shout, but I've just got a couple. Construction costs, which have obviously been a big challenge. I know in our business, we got to the point of recognizing it was cheaper to buy hotel bedrooms than to build hotel bedrooms, which led to a bit of a strategic shift in our business, Highland Coast Hotels. What is the outlook in terms of construction costs? Do you have any sense of that?
Well, it has calmed down, but I think it rather depends on how hard the government pushes with this current building boom. So it's going to push up the cost of materials, and it's going to push up the cost of labour. It's a classic case of being crowded out, I think. If they're going to get anywhere near their 1.5 million homes target over the next 5 years, this huge surge in building. We don't have the builders currently. We don't have the raw materials even to deliver on that. So I think that inevitably is going to have an inflationary impact on costs. So and it's probably going to be cheaper to buy than build for some years yet.
Okay, and my other question was around different market sectors. I mean, clearly post COVID, there was a boom in the staycation market. It took a little longer for the international market to return, but there's now pretty good evidence that, and I mean, one of your slides there sort of referenced it, and clearly I think it's fair to say the US market has been pretty strong in the last year or so. Do you have any sense of where people should be focusing their firepower in terms of attracting market, staycation versus international, and if international, which regions of the world?
Sure. So let's just deal with the sort of main segments. Leisure, transient business travel, and meetings. So I think that most of the froth now has come out of the leisure market, and I think that has seen some headline numbers. If you look at what's been happening at the results of some of the big players, you're seeing their leisure RevPAR figures sometimes come down. I think that's just really froth going out as opposed to any fundamental problem in the leisure market. Transient business travel, I mean, Hilton said last week that it expects business travel to be at 2019 levels next year. So there's still a little bit more recovery to come back in business travel, pretty healthy. But the big boost has been in the meetings market, group travel. So that is coming back, and that seems to be well above inflation growth rates in that group travel market. On the international front, you referenced there the US market. Well, I think today's results of the US election is only going to support further strength in that outbound market. Trump's, who knows actually what he's going to actually do when he gets into power, but his rhetoric around tariffs has already led to a strengthening dollar. Providing we don't end up with a major trade war and economic shrinkage as a result of that. And if he is a little bit more moderate, as he was in practice in his first term, and there's only modest tweaking to tariffs, what we're seeing is a stronger dollar in the US, probable tax cuts. That's going to mean there's Americans with more money in their pockets and with a more powerful currency. So that's going to be a very strong market, I think, going forward internationally as well.
And Asia?
Yeah, so the Chinese are back on planes. They are, there's ongoing problems in China in terms of the economy. It's doubtful they will get back to where they were in 2019. I mean, frankly, Asia is not a huge source market for Europe. I think there's a lot of hype around India, and certainly there's growth there in that India middle class. Probably not as great as the hype suggests in terms of the European context. I mean, I think that the growth in those middle classes is very significant, but that is going to generate travel actually in their immediate regions as opposed to necessarily in Europe. I think certainly, we're going to see growth in the Indian travelers. We're going to see the Chinese come back to a large extent, and encouragingly, I think the shift to free and independent travellers rather than group travellers is going to be beneficial to the market as well.
And in terms of Europe, which of the countries in Europe do we think are going to be strong source markets?
This is a tricky one. So I mean, look at Germany right now; it's sort of in recession or thereabouts. The tariff threats in the US is only going to make their outlook even worse. France has similar challenges. Spain is, Spain, we've always thought of Spain as a inbound market. It's now a significant outbound market as well. Southern Europe, actually, interestingly, in general, is a decent outbound market for us. But I think it's going to remain by far our biggest source of guests. But yeah, I don't think you can look for a lot of growth from those markets.